Good morning. This is Professor Minton, and today what I'd like to do is to deal with one specific area of accounts receivable and uncollectible accounts. And that's because this is probably the most difficult area for you students to understand. And so what I want to do is kind of walk you through a couple of different scenarios in each of the methods that we could employ, one being the income statement approach and the other the balance sheet approach. So let me just talk to you very briefly about uncollectible accounts. And uncollectible accounts are essentially exactly what they say. We are going to sell things on credit, and we expect that some of those accounts will not be collected. And so what we do is we estimate the amount that we're not going to collect, and we create a journal entry that we put to the doubtful accounts expense side on the debit side and the allowance for doubtful accounts on the other side. Well, we have two different methods that we could employ. The balance sheet approach is probably the most well regarded theoretically, but the income statement approach is much easier to do. So we generally use it, to be quite frank with you. So what I want to do is just kind of walk you through these two approaches. And again, typically what I would do is I would estimate my bad debt expense, and then I would debit the doubtful accounts expense, and then credit the allowance for doubtful accounts. Okay, so let's start with the income statement approach, which is this group over here. And so if they don't tell you that they're going to ask you to compute the income statement approach, what they do instead is they make the assumption that you understand that if they're talking about net sales and a percentage of net sales, that net sales goes on the income statement, and therefore they're using the income statement approach. So they never say, well, I'm going to use the balance sheet approach or the income statement approach. They just simply tell you that you have net sales involved or you have accounts receivable. If you have accounts receivable, of course, you're talking about the balance sheet approach. All right, so let's walk through two or three different scenarios here, assuming, first of all, the income statement approach. So they have to provide you with net sales. And remember, you got to be careful because if they give you net sales, but they also tell you that only a certain portion of those are credit sales, some are cash sales, then obviously you can't have a bad debt associated with a cash sale. It has to be a credit sale. Okay, so in this case, I didn't go that far. I just said you had net sales of $3 million dollars, and management estimates that 1% will be uncollected. Well, with the income statement approach, because we're talking about the income statement, what's on the income statement, revenue and expenses. So I'm only concerned with the expense side. So if I make the multiplication of 3 million times 1%, what I'm going to arrive at is 30,000. And then if I don't have a beginning balance in the allowance, this is the contra asset account. That is, it goes against the accounts receivable. And so what I'd have here is 30,000. I don't have a beginning balance. Okay, so that's fairly straightforward. And by the way, that would be the same for either method. Now let's take a look at what happens if we have a beginning balance in the allowance for doubtful accounts. That's the contra asset. So let's explain first of all what that means. If I have a credit balance sitting in the allowance for doubtful accounts, what that means is that I estimated more in the previous year than I actually saw go bad. Okay, so I estimated that there was $10,000 in this case, 10,000 more that would go bad than actually did. All right, so since I have the doubtful accounts system, I'm only worried about the expense, and I already calculated it here to be 30,000. I'll put it here because the expense is not going to change, and I'll put it over here. which means now that the allowance for doubtful accounts will be at 40,000. Again, because I don't care about the fluctuation within this guy. I only care about this guy. All right, so the next one. Let's assume that I have a $10,000 debit balance in the account. What's that mean? Well, that means that I estimated $10,000 less than actually went bad. So just for an example, and what you'll see it here in a second. So 30,000 is what I'm going to do for the expense. And so if I do that, then what has to happen over here is 30,000. And that means that the allowance for doubtful accounts in this case will not be 30,000, but it will be the difference between the two, or equal to this minus this, or 20,000. Now you still got a balanced entry here, okay? But because you had a debit balance to start with here, then you have $20,000 in the allowance because we don't care, again, about whether or not this thing fluctuates. We just have to be sure that the entry is always the same, okay? Now let's flip over here to the balance sheet approach. And I know I'm going through this rather quickly, but the overhead on these things is so high when you start to render them and everything that it takes a long time to render, and the longer you spend on one of these, the more difficult it is and time consuming it is to render. Okay, so in this case, we say that we had Charlie Company had accounts receivable, and that's what they have to give you if it's a balance sheet approach. They have to give you accounts receivable. Now, they might throw in net sales in there, but then they will tell you that the estimated amount is on accounts receivable. So in this case, we estimated 10% will not be collected on accounts receivable. And so in this case, 10% of 300,000 is 30,000. And the allowance for doubtful accounts will be 30,000. And that's because we don't have a beginning balance. So I have to come up with 30,000 because that's what I just calculated in the allowance. I'm only concerned about the allowance here. I'm not concerned about this guy, and you'll see what I mean here in a minute. Okay, so in this case, I have an allowance for doubtful accounts with a credit balance in it of 10,000. What do I have to get to? I have to get to 30,000. So how would I get to 30,000? Well, I would need a $20,000 entry here. And you notice now that I have 30,000 in the allowance for doubtful accounts, which is correct. That's the amount that I have to come up with. You do see the difference, right? Here's 30,000, 30,000, and 30,000. In this case, I have 30,000 here and 30,000 here in the allowance. Now let's look at one more. In this case, we have a $10,000 debit in the account. So that means that we estimated much less than we actually saw go bad. However, we're being told that they're estimating that we will have accounts receivable of $30,000 go bad in the new year. So this number down here has to be 30,000. Well, if this has to be 30,000 and this is a debit, since I added these two, I have to have an amount large enough over here that I can subtract this and still get 30,000. So in that case, I need 40,000. And if I put my 40,000 over here, if I did that right, you see now that I have 30,000 here at the bottom. Okay, that's how you're going to calculate these two things. So remember, again, the key, if it's the income statement approach, once you do your calculation, whatever you calculate for the expense, that's what you're going to record for the expense. Under the balance sheet approach, whatever you calculate for the uncollectible accounts, that's what you're always going to have to end up with. So you'll have to make the entry fluctuate to accommodate this guy. Okay? All right, that takes care of that.